Yes, here's what's on my mind this week. I love the recovery in the market and wanted to build an option strategy around continued bullish price action. So we're going to build a bullish thesis on the S&P 500. We're going to build an options strategy using SPY options. And I'm going to teach you a little bit about a bull call spread. And I'm going to compare it to a long call option. So you're gonna essentially learn the pros and cons of buying a long call versus buying a bull call, and we're gonna break both of those strategies down. So let's start with SPY. And earlier in the halftime report, we kind of made the pitch for this, but let me explain to you how I would build this thesis. Mark did a good job of this earlier with crude oil. We want to stack the odds in our favor. We want as many variables in support of whatever our trade idea is. So if you take a look at the S&P 500 right now, from a technical perspective, you have a bullish breakout over 470, breakout over 470, call it 471 and change, right? You have December. We're in the middle of December. We have bullish seasonality. Historically, this is one of the more bullish months of the year. When they talk about the Santa Claus rally, some people, and Matt alluded to this earlier, some people would think, okay, December's bullish, Santa Claus comes in December, so September, or not September, but the Santa Claus rally is December bullishness. Well, true and not true. There actually is a very specific time frame that is the Santa Claus rally. That's the last 7 days. Actually, I think it's the last 5 days of the year and the first 2 days of the new year, right?
Yeah, it's right after Christmas. It's run right after Christmas.
Yep. So historically, that 7 days has been very, very bullish. And so you say, well, what do you think could derail this? Well, Omicron and the market throwing a tantrum coming into December kind of put expectations of year-end bullishness and festivity and cheer on ice. But yesterday, I feel like the market says, hey, game's back on. Bulls now have the benefit of the doubt. So I like how things are shaping up for a year-end run, and I think that supports anything bullish on the S&P here. So the question is, well, what do you want to do? And quite honestly, I think you could do just about anything, but I tend to do a lot of credit spreads and cash flow trades. Today, I wanted to mix it up a little bit and illustrate going more directional, whether by buying a call or buying a call spread. And deciding between the two is easier to do when you understand the dynamics, the characteristics, the trade-offs. So that's kind of what I want to get to here. I have to buy an option that exists and will last through the end of the year into the beginning of next year. So we're going to be using January options. I'm going to use January options so that I have exposure for the time frame that I'm analyzing. And market's at 468. So let's start with this. Let's say that I bought a January call option. And I'm just going to buy the 470 strike, which is essentially at the money, slightly out of the money, but I want to have a nice round number here. So if I bought the Jan 470 call, it would cost me let's call it $860. So not terribly expensive, but $860 for an option trade is kind of expensive. So choice one, I could buy a call option. I could go long the Jan. It said 370 or 470. Yes, 470 call at $8.60. I like to look at the risk graph to get a sense of what my risk is versus my reward, as well as my Greeks, right? So this is a long call option, limited risk, unlimited reward. The risk is what I pay, $862, and the reward is unlimited. Of course, I only have 45 days of time here or so. So max loss $860, max gain unlimited. I would also look at the break-even price. If I were to hold this to expiration, that's the little hash mark, the stock would have to go from the current price all the way up to 478.60. 478.60. So I pay $8.60. I need the call to be $8.60 in the money at expiration to recoup my cost. Now, what is the delta? What is the delta of this option? This is a 47 delta option. I could even look at the theta, it's -10. So delta's 47, theta's -10. Now, that's my baseline. I could do this trade, fine with that, could put a stop loss. I'm not going to risk the whole 860. And, you know, if Santa Claus comes and we get a nice little pop in the year in and this thing gets up towards 480, I got a decent amount of profit. You know, 480, if it happens quickly, you're talking, you know, 680 bucks, right? Now, what if I want to consider something a little less aggressive, something a little less expensive, something that's less risky, something that has a better probability of making money? That's what might take me towards the bull call spread. So this is choice 2. I'm going to start the same way. Okay, I'm going to buy that Jan 470 call at $8.60. The difference is I'm going to sell something against that. That's what a spread is. You buy one option while selling another. That short option is going to reduce the overall trade cost and have a lot of other, you know, implications. So 480, I think, is a very realistic target. I think we could even go beyond that. But for now, I just want to do a simple $10 spread. I want to sell that 480 strike against the 470. And if you use the control key, you can basically just go find the option you want to sell, hold down control, click on the bid price, and it will add it to that existing long call, thus structuring a vertical spread for $4, and let's call it 475. So long the Jan 470, short the Jan 480. The net cost, let's forget that 860. The net cost here is 475. So the maximum loss is now $4.75 per share, or 475 bucks. So immediately I've cut my risk almost in half. You don't get something for nothing. What did I give up in exchange for cutting my max loss essentially in half? Well, you now have to sell the stock at 480. You know, taking a step back, when you buy a call option, you've got the right to buy stock at a set price. I had the right to buy stock at 470. By selling this call, I've got the obligation to sell it at 480. You buy something at 470 and you sell it at 480, 10 bucks is essentially the maximum amount that you would make. So this spread value maxes at 10 bucks per share times 100 is 1,000. So my max gain is 1,000 minus the trade cost, which is 475. So long story short, 525 bucks is my max gain. And that really is the biggest drawback to doing the call spread, is now I've capped my upside. But you'll notice it's still substantial. I've capped it, but I get still more than double my money. After all, making 525 on 475, it's 100 and essentially 110% return. So I don't know that I'm going to be too bent out of shape if this thing gets up there. At the same time, consider the Greeks. My delta is not -10 anymore, or excuse me, my theta is not -10 anymore. It's -2.4. And so what have I done to my exposure to time decay? Well, it's minimized significantly. And so I can sit here and be a little more patient, a little less anxious as the market, or if the market takes time to go up. Maybe this breakout doesn't happen as fast as I wanted. When you're losing 10 bucks a day due to time decay, you get a little anxious. Long calls make me anxious. Bull call spreads easier to give some room and sit back and not be as I don't know, anchored on what's going on day to day. So less time decay. And then finally, the delta is also going to be dramatically less, 18 delta instead of 47. So no, I'm not going to make money as quickly as had I bought the long call. But that 18 delta will still add up significantly to a $525 gain by expiration if we can get above 480. So this is the type of trade that I prefer. This is my favorite strategy when I want to go directional. It's pretty rare for me to do a long call. It just is a little more aggressive than I want to go. I think it's a willing and fair, or let me say it this way. I think it is a fair trade-off to cap the gain at 100% plus return in exchange for cutting the risk in half. And by the way, if I used a stop loss, risk is even reduced even further. So say I put a stop below yesterday's low, for instance, 459. Now the risk reward really starts to look sexy, because 459, I'm losing 150 bucks. Not a whole lot of risk here for a decent amount of upside. So, all right, there you have it. Bull call spread versus long call on this SPY breakout.